Warren Buffett is widely considered one of the greatest investors of all time. He is the chairman and largest shareholder of Berkshire Hathaway, a multinational conglomerate holding company, and has consistently generated impressive returns for his shareholders over the past several decades. Learning from successful investors like Buffett can provide valuable insights and strategies that can be applied to one's own investing approach. In this video, we will take a closer look at some of the key lessons that can be learned from Buffett's career and discuss how to apply these lessons in your own investing strategy. Lesson 1. Power of compounding. Compounding refers to the process of earning interest on interest, allowing an investment to grow at an increasing rate. This is one of the most powerful forces in investing and can lead to significant returns over time. Warren Buffett has long understood the power of compounding and has used it to great effect in his investments. By holding on to high-quality companies for long periods of time, he has allowed the power of compounding to work in his favor. To apply the power of compounding in your own investing strategy, it is important to focus on long-term investments and choose the companies with strong fundamentals that are likely to grow over time. Additionally, reinvesting dividends can help to accelerate the compounding process. Lesson 2. The importance of patience. Patience is a key component of successful investing. It allows investors to make thoughtful, well-informed decisions rather than acting on impulse. Warren Buffett is known for his long-term investment approach and his ability to stay patient through market fluctuations. Patience is also important for allowing investments to fully mature and reach their full potential. By holding onto investments for the long term, investors can avoid the temptation to sell during short-term market downturns and instead allow their investments to recover and grow. To develop patience in your own investing approach, it is important to have a well-defined investment strategy and to stick to it, rather than reacting to short-term market fluctuations. Additionally, having long-term perspective and focusing on the fundamentals of the companies you are investing in can help to maintain patience. Lesson 3. The value of research and due diligence. Research and due diligence are essential for making informed investment decisions. Warren Buffett is known for his thorough research process, which includes reading annual reports, financial statements, and other relevant materials to gain deep understanding of the companies he is considered investing in. By conducting thorough research and due diligence, investors can identify potential red flags and gain better understanding of a company's financial health and future prospects. This can help to make more informed investment decisions and potentially identify undervalued opportunities. To conduct research and due diligence in your own investing strategy, it is important to gather and analyze relevant financial information such as annual reports and financial statements. Additionally, reading articles and analyst reports and paying attention to a company's management and industry trends can provide valuable insights. It's also important to have a process in place that allows you to evaluate the information that you have gathered and make an informed decision. Lesson 4. The dangers of overvaluation. Overvaluation is a common pitfall in investing and can lead to poor investment returns. Warren Buffett is a value investor and is known for his ability to identify undervalued opportunities. He focuses on finding companies that are trading at a discount to their intrinsic value. Overvaluation can occur when investors overpay for a stock, buying it at a price that exceeds its true worth. This can happen when investors are caught up in market hype or when they fail to properly evaluate a company's fundamentals. To avoid overvaluation, it is important to focus on value investing and to conduct thorough research and due diligence. By analyzing a company's financial statements, looking at its price-to-earning ratio, and comparing to its peers, investors can identify if a stock is overvalued. Additionally, it's important to have a clear understanding of a company's intrinsic value and not to pay more than that value. Lesson 5. The importance of diversification. Diversification is a key principle in investing and it can help to reduce risk. Warren Buffett has a diversified portfolio which includes a mix of stocks, bonds and other assets. This allows him to spread the risk among different investments and sectors, rather than putting all of his eggs in one basket. Diversification can also help investors to weather market downturns. By holding a variety of investments, investors can reduce the impact of any one investment performing poorly. To diversify your own portfolio, it is important to invest in a variety of assets and sectors. This can include stocks, bonds, real estate and other investments. It's also important to have a mix of domestic and international investments, as well as large cap and small cap stocks. Additionally, you should review your portfolio regularly and make changes as needed to maintain a well-diversified portfolio. Lesson 6. The power of a strong brand. A strong brand can be value assets for companies and can lead to long-term success. Warren Buffett has invested in companies with strong brands such as Coca-Cola, Coca-Cola, American Express, and Wells Fargo, which have proven to be successful investments over time. A strong brand can provide a competitive advantage and help companies to attract and return customers, generate higher sales and profits, and increase their value in the long term. To identify and invest in companies with strong brands, it's important to look for companies with a reputation for quality, a loyal customer base, and a strong reputation in the industry. Additionally, it is important to pay attention for the brand strength, indicators such as customer loyalty, brand awareness, and brand reputation. Furthermore, it's important to consider the management team and their ability to maintain and strengthen the brand over time. Lesson 7. The importance of having a margin of safety. A margin of safety is a buffer that helps to protect investors against potential losses. Warren Buffett is a proponent of using a margin of safety in his investments, and he looks for companies that are trading at a discount to their intrinsic value. Having a margin of safety means investing in companies at a price that is lower than what it's actually worth. This can help to protect against unexpected events such as a drop in earnings or an economic downturn that can cause a stock's price to decline. To incorporate a margin of safety in your own investing strategy, it's important to focus on value investing and to avoid overpaying for a stock. Additionally, it's important to look for companies that are trading at a discount to their intrinsic value and to consider the potential risks and uncertainties of the company and the industry. Furthermore, it's important to have a process in place that allows you to evaluate the information you have gathered and make an informed decision with a margin of safety in mind. Lesson 8. The benefits of being a contrarian investor. Contrarian investing is a strategy that involves going against the crowd and investing in out-of-favor assets or companies. Warren Buffett is known for his contrarian approach, often buying stocks when they are undervalued and out of favor with other investors. By being a contrarian investor, you can potentially identify undervalued opportunities that others have overlooked and potentially generate higher returns. Additionally, by going against the crowd, you can avoid the potential pitfalls of herd mentality and groupthink. To develop a contrarian mindset in your own investing strategy, it's important to have a long-term perspective and be willing to go against the crowd. Additionally, it's important to conduct thorough research and due diligence, and not to be swayed by the market sentiment or hype. Furthermore, it's important to be patient and to be willing to hold onto investments for the long term, even when they are out of favor with other investors. Lesson 9. The value of strong management team. A strong management team is crucial for a company's success and can lead to better performance and growth. Warren Buffett places a high emphasis on the importance of a strong management team and has invested in companies with a history of strong leadership. A strong management team can provide vision, guidance, and direction for a company and can make strategic decisions that lead to growth and profits. Additionally, they can navigate through difficult situations, adapt to changes in the market, and create value for shareholders. To evaluate and invest in companies with strong management teams, it's important to research the background, experience, and track record of the management team. Additionally, it's important to pay attention to the team's communication and transparency with shareholders, and to look for a history of good decision-making and successful performance. Furthermore, it's important to pay attention to the company's corporate governance and board of directors, as they are responsible for selecting, evaluating, and compensating the management team. Lesson 10. The importance of staying disciplined. Discipline is crucial for successful investing and can help avoid impulsive decisions. Warren Buffett is known for his disciplined approach to investing, sticking to his strategy and avoiding the temptation to make impulsive decisions. Staying disciplined means sticking to a well-defined investing strategy by avoiding emotional decisions. This also means being patient, avoiding impulsive buying and selling of stocks, and not getting swayed by market fluctuations or hype. To develop and maintain discipline in your own investing strategy, it's important to have a well-defined investment plan and to stick to it. Also, it's important to avoid emotional decisions and to have a long-term perspective. Furthermore, it's important to avoid the temptation to time the market or to chase after hot stocks. By staying disciplined, you can make more informed investment decisions and avoid costly mistakes. Warren Buffett's career has provided valuable lessons that can be applied to one's own investing strategy. From the power of compounding and the importance of patience, to the value of research and due diligence, diversification, strong brand and a margin of safety, the contrarian approach, the value of a strong management team, and the importance of staying disciplined, these lessons can help investors to make more informed decisions and to achieve better investment returns. By taking the time to learn from successful investors like Buffett, you can gain valuable insights and strategies that can be applied to your own investing approach. By applying these lessons, you can potentially increase your chance of achieving success in the stock market and reaching your financial goals.